please welcome to Johan Lorenzen on stage. Get up for him.
Thank you. Stage is yours.
Thank you very much. Hello, everybody. Pleasure to be here. Awesome event. Had a great couple of days. Good job on the organizers. When I first got the invitation to do this, it was sort of, can you tell us something about early stage investment? And I was thinking, well, we could do that, but most of you know everything that's out there anyway. I mean, how to talk to investors, what the terms look like. But seeing it from a venture perspective, it sort of dawned on me that most VCs spend a lot of time as entrepreneurs, but very few entrepreneurs really knows what a VC side looks like. And it's a changing industry, so I think I'd have two objectives for this talk. First of all, what is happening in European venture, because it's a landscape that is changing pretty rapidly. And second is give you a couple of very simple tools to try to navigate this changing landscape. First of all, a couple of words on what we do. I'm with Sunstone Capital. We're a fairly young venture firm out of Copenhagen. Some of our more known investments are Podio, Prezi, Issue, and Boost. We set up a new fund last year, 85 million euro. And we've been making 4 investments so far. It's been Gitsy, Amen, Freesby, and Makey Labs. So really scattered around Europe. But to tell you what's happening in European venture, I've built a database of 56 European institutional investors. It's all the brand names that we know and love and have seen for years. I've filtered out all the government programs. I filtered out all the accelerators, angel investors, just to give you a clear view of what the institutional landscape looks like. And there's 2 major conclusions in this. First of all, if you imagine how the whole thing is connected, imagine every venture fund that's ever done a deal. If you have a mental picture that looks something like this, then you're absolutely right. That's what it looks like. You could dive into it. You could get lost in there for weeks. I sometimes do. But if we zoom out and try to take the broad picture, then 2 things are happening. One is there's very, very few deals happening, or new deals happening. In 2000, we had about 100, or 2010, we had about 100 new companies entering that ecosystem that year. So far, in 2012, we've seen 28 new companies, a drastic decline. So why is this happening? 2 things. Whoops. First of all, there's very little capital being raised. This is what's going into Europe as an entire ecosystem. It includes life science, technology, everything. So drop down from about 11 billion euros to about 4 this year. And if you look at where it's going, it has sort of 2 components. Some of it is going into multi-stage investment, and some of it into early stage investment. The early stage investors are the guys who do seed and A round as their bread and butter. The multi-stage investors are the guys who do optionality bets in an early stage venture. It's the guys who can afford to take a small stake in the beginning and then follow up later if everything works out. We don't have the manpower, the capacity, or the pockets to do something like that, but it's a viable strategy. So the early stage investors are divided into pan-European and regional, where there's very few funds that really take a European perspective on venture. Lots of regional stuff. The multi-stage guys, if you want to access those, where the bulk of the capital goes, London Heathrow is what's going to be on your plane ticket. So where do they spend the money and where does it go? So I've devised this small analysis tool I call the sector matrix. On the one side, there's a technology stack. It tells you where it goes. It's everything from semiconductors down to consumer internet. On the top side, you have your sectors. It's automotive, it's finance, it's telecom. And if you look at that as a whole, the size of the bubbles tell you where does the capital go. So from 2007 to 2010, you had a wide distribution. You could still raise capital for hardware, you could do for components, you could do it for specific infrastructure software types. But if you look at how does that look if we fast forward to 2012, very, very different landscape. Everything is happening in consumer services. So we're moving up the technology stack and into specific verticals. And the main conclusion is basically, if you're not in those verticals, you have very little chance of raising money. So, how do you select the investors that fit your perspective best? Well, it sounds very simple in many ways, But if you ask your investor 5 basic questions, you have a huge upper hand in selecting your most potential investors. It's pretty simple. It's when did you do your last investments? Are you still making active investments? When did you raise your last fund? Meaning, are you in an active cycle? The size of the fund tells you where they are in the multi-stage or early stage. So it's an important question to ask, and you also need to ask them where and what. So, let's try it out in practice. I've lined up investor pool, 56 brand name VCs. This is an indication of what they're actually doing, not what they intend to do or what their strategy is, but what they're actually doing. So let's try it out. Let's ask them. How many of you guys have made new investment within the last 12 months? Oops, there you go. Well, 36 out of the 56. The rest, they're busy maintaining their existing portfolios or raising new funds, and probably wouldn't be that interested in looking at early stage deals. And I mean, you don't have to ask them directly. You can look at their websites or their press releases and see where they are. Second, we need to ask them, have you raised a new fund within the last 3 years? Because if you haven't done that, you're probably not in an active period, and you're probably not taking in new early stage investments. So now we're down to 17 out of the 56. How many of the investments you did were actually in early stage venture? Well, then we can narrow it down a bit more, and if you're looking for early stage funding, now you have 7 investors to pick from. It's a lot easier than having coffee and meetings with 56. So pretty simple way of honing in on that. The next question you have to ask yourself is, what about based on geography? What if I need to access capital outside my own home region? What if I'm based on the fringe area of Europe? If I'm based in Zagreb or Croatia or somewhere where we don't really have that history of institutional investors? Well, let's try it out. See how many of you guys are investing outside your home core regions. Well, you're down to 4 out of the 56. Okay, so the next thing is, when you've identified those 4 or 5, then you need to get really close to them and know what is their investment thesis. I mean, you just ask them directly. Most VCs think, well, we want a great team, we want sustainable competitive advantage, we want all these things at a great price. Well, that's okay, but it sounds like a bit of an anti-thesis, because I don't know any VCs who say, well, we'll invest in shitty teams with shitty technology and no defendable market size. So it's really just the qualifiers. Every investor below that has a thesis, and it's a good way of getting to know that before you talk to them. I mean, I'll be quite frank and do my mental checklist of what do we look for in companies when we start engaging with them. This is actually a poster I did for a Tech Hub event, because it was one of those questions we've been asked a lot, so let's just try and get it out there. First of all, you need to be aiming to change an industry. You need to have a really big use case, something that disrupts an existing market, existing value chain, really large. Be gutsy, aim for world domination, it has to be in your genes. Second, try to create a product that spreads like the flu in December. Something that brings down your customer acquisition costs, something that keeps you more lean and more agile than your competitors. I mean, it could be either on the cost side or on the revenue side, it could be virality, it could be open source, it could be something that accelerates either your cost or your revenue side. Second, you need to be capital efficient until you have your product fit. This means that we cannot invest in things that takes years to find out if it works or not, or if it takes a huge upfront investment. So if you want to build a hardware component, that typically falls in within that space. So the mantra goes, if you can touch it, we don't really want to touch it. Second is, have the team ready when you get there. Have all the components of a great team in place when you approach us. And the last thing is, show some pulse. Show something that shows that you know your business, you know your funnel, you know your customers, you know how the ecosystem works, and you're ready to accelerate it. That's sort of perspective from our side. Yes? Thank you very much.